Good afternoon, everyone. My name is Ashwind from 7Hedge. And today we have James, who's the managing partner at Sharpe and Sigsworth. We have Jonathan Davies, who's the head of currency at UBS Asset Management. Yoav, director at Victory FX. And Gordon Ibrahim, who's a senior portfolio manager at BlackRock. The topic today is mainly to address whether FX is actually an asset class. And if it is, can we make money out of FX? And if so, how? Right, so without delaying any further, I'll firstly put the question to perhaps James. Is FX an asset class?
Well, actually, I've got a question for you guys first, and ladies, of course. After this morning's brilliant presentation by Gordon, are any of you thinking of converting your pension fund into a currency fund? Well, that sounds a reaction, not sure. I think FX is I'm a bit ambivalent towards FX as an asset class. It seems that sometimes it works, sometimes it doesn't in that context. I think when you look at FX, the original idea about FX as an asset class was its diversifying attributes. As we've mentioned this morning, as Gordon mentioned, if it correlates with equities, then it's no longer diversifying, and therefore it doesn't really have any value in a diversified portfolio. Whether or not, I think if we look at the recent picture, FX has performed very badly. And it seems to perform well as an asset class when certain conditions apply. And I think those are basically, I'll say, three conditions. One, you need carry. And if you look at all the performances of asset funds, currency funds over the last 10 years, a lot of them generated their initial incomes from carry. Secondly, volatility. Certain types of system funds require volatility. And in fact, any market, any FX trader, when I used to do FX trading, without volatility, you weren't going to make any money. And also, you need direction. You need a trend. If you don't have a trend, it's difficult to make anyone to make any money if you think in terms of a medium term of investment. And that's where we get in terms of any asset. Are we talking short-term plays? I mean, Yoav there, you run a fund there where you do medium-term trades. You do medium-term trades. You do medium-term trade. Are we talking about FX in terms of a medium-term context? Or are we talking about FX as an asset where we will just trade it, as in the old days we would call it a jobbing? So in terms of a fund, we're just going in and out on volatility over a very short-term basis. I think at the moment, I would say I would not view it as a strong asset class contender.
Right, purely because of the importance of correlation to equities and possibly bonds.
I think it's very inconsistent candidate.
Right. Yoav, I know you run sort of discretionary, but as well as some sort of a systematic model. So how does this idea of correlation to the other asset class matter to you at all, or is that something that you wouldn't consider as being very, very significant in defining FX as an asset class in itself?
For me, FX is an asset class simply because it meets my definition of asset class, which is a group of securities which are tradable in a liquid market and subject to regulation law. So all conditions are met here, and as such, for me, it is considered an asset class. What it is lacking is a formal benchmark. So, for example, equities, you got the S&P, et cetera, et cetera. You don't have that with FX. So, in a way, it's blurry. But because of what I've said, it should be considered as such. On top of that, I would add various side effects which makes it the unique and intriguing asset class that it is. By this, I mean it is like a medium exchange for other asset classes. In other words, other asset classes are denominated in currencies. So your gains or losses in other asset classes may be offset by currency gain or loss. So it's a mean of diversification. Moreover, the business transactions, including hedging, overlays, and let's say if the US buys from Japan, Toyota or Sony products for, let's say, 1 billion, at some point, this has to be converted to Japanese yen. So that's another effect in the market. So those are side effects on top of the basic formal, my definition of asset class.
Right. Thank you. Jonathan, what's your take on this matter, correlation, and how you use it to manage your exposure of other investments that you make within the UBS group?
Well, FX is a separate investment decision. For all intents and purposes, it is like having a separate asset class to manage. I think, strictly speaking, we might say all securities, financial securities, have an FX exposure. It's something that is attached to all of them. When we manage FX, effectively what we're doing is we're taking long and short positions in short-term cash rates to isolate the change in exposure we get purely from the currency of denomination. The important question is, can we generate alpha by managing our currency exposures? And the answer to that is yes. We find as amenable to investment signals as managing bonds or equities. And in fact, we find that if you use common sense fundamental signals, these are very effective in generating excess returns. Any asset class, there'll be times when there are strong investment signals coming out of that, strong alpha signals, and sometimes when they're weak. So sometimes you'll have the conditions in place to be generating a lot of alpha, and sometimes you won't. I think recently we've been through a patch where the investment signals have not been particularly strong in currency. But that happens to all investment strategies, and there's no reason to think that the opportunities to generate alpha in currency management are not going to come back in the future.
Right. So in today's sort of environment, what could eventually encourage anyone to go into FX and as a source of generating alpha? What in your...
Well, they see a direction. They see a direction emerging. Mm-hmm. And they may well be seeing that now, because we were just talking beforehand, and we may well be seeing a change in the outlook for the dollar. One of the reasons why the currency funds did so badly, because they got the dollar wrong. And so we may well be seeing a change there. And what the market needs is a direction to play off, and then you'll start seeing some really fantastic performances. Then you might want to see, and we may also see a change in yields, change in spreads, and that will encourage some form of carry coming back into play. Again, that will improve returns. So that's how I would see it, very briefly.
Right. Gordon, you obviously manage a number of assets, FX including in there. How do you see FX in your sort of operations?
So I'm not actually draw on some of the points that Jonathan made, that FX is a standalone decision point, or I might say should be. It isn't always. Some people sort of treat FX as the residual. Maybe they'll make their investment in an overseas portfolio and then sometimes decide to hedge the FX risk and be neutral, and sometimes decide to take the FX risk with them. Not necessarily thinking about the increased volatility that FX can contribute to your portfolio. If we look at FX volatility, it's been probably 2/3 of equity volatility over time, which is very significant if we're thinking about the volatility contribution to your overall portfolio. So from that respect, I think FX should always be considered as a separate decision point along Jonathan's point. And this is the way we think about FX at BlackRock. It is a separate decision point. We would run it, whether it be within our multi-asset portfolios as a decision, it's a decision point. So the decision may be whether you want to hedge your exposure and have zero exposure, or a separate decision, can we try and generate alpha from FX? again, I think our view is that there is potential there. I think, as has been mentioned, the asset class has been challenged over the last few years. But I think one other aspect to this sort of conversation, whether FX is an asset class, we have to remember it's a relatively new investment proposition. So currencies were pegged, the majority of currencies were pegged either to gold or to some other local currency until a relatively recent period compared to the period when we look back where people have invested in stocks. So a number of new investment strategies are constantly being developed. Obviously, the carry trade was a flavor for some period. That doesn't mean that's going to be the sort of aspect going forward. Just to pick up on the beta point as well, I think that is an important point for FX investors, because typically equity investors would be measured against some sort of benchmark, the S&P. We don't have that in FX. There's still this unanswered question as to whether there is a beta in FX, which may go to some way to help explaining whether we can really think of FX as an asset class. I think the carry trade is the closest to a beta that we get in FX, that there may be a sort of harvestable risk premium that you take there. Investing in the carry trade generates excess volatility, but that is something that you can harvest over time. However, it's still open for debate, I think, from our side, whether you can purely have a beta in FX.
Right. The carry strategies, they used to be working very well when the markets were sort of trending somehow, and together with the sort of momentum strategies, I believe they were used jointly. Since I believe 2008, that sort of relationship broke down to some extent. So how's
Meltdown, actually.
Right. Now, what has been the impact on sort of firms using FX a little bit like yourself, and what new avenues or new opportunities did you find then from the resulting situation that we had post 2008?
So I think somewhat moving away from those necessarily traditional drivers. So simple allocation to the carry trade, to some sort of trend factor and some sort of valuation factor has been important to generate FX returns. Some of the sort of simpler signals, potentially focusing more on the short to medium term rather than having an almost passive longer term allocation to a certain strategy or signal, has certainly been important in terms of adapting the way we think about FX and FX investing. Even in the period sort of pre-2008, we had a sort of shift away from some of these more generic strategies, which was difficult because they were performing extremely well at the time. But the sense that these were becoming more, I guess, more ubiquitous amongst investors is always something that we would try and challenge, because essentially then you're moving to a pure beta factor exposure rather than something which is more specific to alpha generation.
Thank you. Jonathan, do you agree with the fact that FX, right, itself, going up beyond the sort of correlation, how it correlates to other sort of asset classes, because of disparities, really, different players in the markets have different requirements. Are there not enough opportunities in those to sort of leverage and generate alpha?
So I think your question is FX, if you take active FX positions, is it adding breadth to the number of portfolio decisions you can make? And the answer is definitely yes. Actually, there's been a steady improvement in liquidity in FX over the years, so that currencies that would have been considered exotic a few years ago can now be traded in reasonable size with leaving a very small footprint. But what we find is that the really important thing is that our FX strategy has very low correlation with other asset classes. In fact, the correlation of our FX, this is our active strategy, so the active positions we're taking has been negatively correlated with almost all other asset classes over the past 5 years. So equities, high yield bonds, corporate bonds, hedge funds, and so on. The only one where there's been a small positive correlation is with global sovereign bonds. So, you know, it really does make a difference that there are different drivers here that move FX positions around. There are different, the sources of alpha are different. So just applying the standard theory about the law of active management, the more independent bets you have, the better your performance should be over the long run, and that's certainly what we have experienced.
I will add one more comment. The uncorrelation is not only between FX and other asset classes, but within FX, the strategies of trading FX, there is high uncorrelation among them. This is one of the reasons why investors go to FX.
Well, I think that's a very good point. So somebody who has a strong carry style, the performance of that's going to be very different from somebody with a strong value style. So we have one major client, for example, and they told us, well, just to let you know, we have another currency portfolio with a different manager, and the reason we've done that is because he's managing it in a very different way from you. And this is a client that had the explicit aim of wanting equity-like returns, but in something that has low correlation with equities, which is why our strategy stood out. But at the same time, they've also diversified their currency portfolio by getting in another manager with a different approach from ours.
To continue the point of why investors find FX to be an attractive asset class, I think we should add a few points which we all are aware of, but they have to be pinpointed. Those are, for example, the 5x24 markets. It's the true around-the-clock market, unlike other asset classes. It's the most liquid asset class by far. It's a true absolute return kind of asset class. And I think there is an opportunity there to get excess return if you know what you're doing. So for all these reasons, I think investors go there beyond all the key points that have been mentioned, including the diversification.
Right. Do you think to take advantage of those opportunities, technology has played a big part in those things? Is it because now everything we have EFX, there's a lot of high-frequency firms that's come up? What's been the impact of those firms and technology onto the general opinion on FX as a medium for generating alpha? You being in that particular.
I'm in the camp of discretionary, so I guess the people who know better about the subject. But generally speaking, in my case, the years of R&D were in developing the algorithm. So it's not about the technology. Technology may help with faster execution and these sort of things, capturing very fast moves, looking for small gains. This is not the case in my strategy. I'm looking for fewer opportunities, maybe 10 or 14 in a year, which are huge in size. And the probability, HFT is, from what I know, they look for probability of 55%, 60%. And in my case, it's very different, much, much higher, closer to 90%. So it's different, very different trading style.
Yes. And does that require different sort of levels of access to liquidity?
Not in my case, because my trading style is about scaling in and scaling out. So I do not look to soak the market capacity at this very millisecond. But maybe Jonathan or Gordon, they probably will know better.
So I mean, our trading strategy is not high-frequency trading. It's an investment horizon of probably 2 to 6 weeks, so relatively short-term investment, but not the very high frequency. I think on the technology side, that's sort of changed the way we invest is the access to information, the ability to have large databases to be able to backtest signals much more effectively in terms of whether we're looking at technical signals, whether we're looking at growth signals based on economic fundamentals. So that sort of that improvement in the availability of information has been very important, and it's something that we as a firm have invested very heavily in to improve our technology platform to be able to capture this sort of data.
Yes, these are obviously very important parameters to leading us to the next question. Really, is how do we actually make money in FX? What sort of strategies are out there, and when do they actually work? Under what conditions do they add value? James?
Well, I'm just fascinated by the idea always people make money out of FX, because I've been involved in FX markets for nearly 40 years, and the reason why, how many prop desks are left in London? Well, I don't think there's that many, and I used to know some of the people who were trading those prop desks, and they're no longer with us, in that sense, still around. It's extremely difficult to make money, and that's why the banks changed their whole strategy, because they became liquidity pools. Basically, it's all volume, and they kicked everyone out, they elbowed everyone out, all the small boys out, and they got these big pools, and they're running their show on there. You can make money in FX. My point is, can you consistently make money in FX? We see, I've got some figures here about some of the funds. I've got access to a lot of our fund performances. And some of the performances going back are stellar. Then it all goes pear-shaped. And that was the pattern of a lot of prop desks. Have a great year, get big bonus, next year all goes down the tubes, So I think going back to what we were saying early on, I think that's what you've alluded to as well. I think there is scope to make money, and it depends on the size of the kind of positions you make, the kind of strategy you have, but you do need to have certain conditions in place. You're not going to job it, because that's not going to be the name of the game now, I don't think. Electronic systems, model funds don't seem to perform that great, it seems to me. So, I think you have to look for a nice direction and get on the back of it.
Right, so the old-fashioned way.
It's basically it's basically having a punt. Now there were very sophisticated people here, I know. It's overlay or whether or not you're taking a decision. I think one of the things you're talking about, the impact of the collapse of the carry trade. In my book, I described that as tortuous panic, and it's closed door panic. And basically, if you've got a position that's rubbish and you're all trying to get out of it, the whole thing is just going to floor. And I think really the herders will follow, and then hopefully you'll get out before everyone else does.
Yes, so just get on the trend. Is that the same sort of principle you apply, or are you, based on existing exposure, forced to make certain decisions without having the sort of ideal conditions?
We will not blindly follow trends. Just to go back to James's first point, we have been accounting for FX as a separate decision since 1981, and we can trace the performance, it's how much it's added to a fund over that time period, and it's added about 40 basis points per year extra return over that time. Now, James says, can you do it consistently? Well, it's not possible to do it consistently in the sense that you can guarantee to add alpha every year. You need to stick with a process, and you'll probably find there will be negative years, and you may get 1 or 2 negative years. But if you stick with sound fundamental processes, you will then recoup all of your losses and make more. In my experience, where people tend to lock in losses when you have a period of underperformance, people say it's not working, let's shut it all down, and you lock in all of that underperformance. So sorry, Ashwin, what was the second part of your question? What was the question you just asked me?
Sorry, it was whether based on your existing exposure, right, you don't necessarily have the chance to wait for a trend.
Oh, you're talking about the herd following, the trend following. Well, there's actually, often you can see a trend in a certain direction. I find these days it's not possible to pick up on a trend quickly enough to exploit it. So I think trend following techniques, which did seem to work a couple of decades ago, they don't really work now. When you think that something has got into a disequilibrium state, an unsustainable state, so you say this exchange rate is misvalued, in much the same way you might say this equity market is misvalued for whatever reason, then you have the opportunity to say, right, there's going to be a correction, let's exploit that. The difficulty, though, is with the timing of that, because you don't know exactly when that correction is going to happen. So these, if you apply your fundamental analysis in a disciplined way, it is possible to identify situations where exchange rates are fundamentally misvalued. But you've then got to have the patience and the patience of your clients to be able to exploit an investment strategy that's based on managing that disequilibrium.
How much of your view is based on fundamental compared to technical?
Well, mine's largely fundamental.
Right.
Just because I've not found ways of exploiting technical signals very well, but I know other people do use technical signals a lot, and I'm open-minded that that's another way of making money in FX.
The investment process that we take combines the two. But practically, what our strategy does is identifying genuine from false breakouts of long-term price range. Usually, genuine breakout as such is associated with a new market theme, new consensus view, which will dominate the market for a while, for at least 2 weeks. It's not going to change tomorrow. So it's more like a holistic view. Now, I would like to add one key point regarding what James said about the challenge of generating consistent gains. It's one approach to go at the market every day with similar probability, but this is not the approach we are taking. We might be sitting idle for a while, maybe even 3 weeks. But once the signal is on, the probability is totally different for us. Genuine breakout, it's a strategic decision by the market, and our system is able to identify this with 90% probability. That's our approach.
Right. And Gordon, in terms of how technicals compare to fundamental on your side in terms of choosing where to offset risk and where to hold on to risk, what's your current practice right now?
From our side, it varies over time. So I think this also comes back to the ability to try and consistently generate alpha in FX. The first question is, do you want to be in the market all the time? I would say probably no, or at least at reduced risk levels, higher risk levels, and have the ability and the confidence to vary that considerably. And then also try and have some ex-ante measure of what is going to be working in the coming market environment. That's obviously extremely tricky to do, but...
How often should one be reviewing those strategies, as in?
Every day, continuously. I mean, it's when I'm not sitting here, I'd be thinking about that in the office. It's something that it needs to be continuously reviewing. One way of doing it is looking at backwards-looking performance. So we can see if our more technical signals have been working versus our more fundamental signals. But to actually try and have a more forward-looking analysis to understand what sort of market regime these signals might or might not work in, I think is very important. And a sense of when the overall FX portfolio may have the ability to generate alpha or when we have lower confidence. Because I think we've all generally agreed that we can probably make alpha in FX, but we have to or from our side, we'll certainly admit that it's a strategy with a low information ratio. So there's the ability to generate alpha, but at a risk-adjusted return relative to some other asset classes, it's more challenging, which means you will tend to have periods, as Jonathan mentioned, you may have 2 years of underperformance. And if you can try and limit your losses by having lower risk run during those periods, that's a great benefit to your investors, and you can hopefully live to fight another day. You won't get the investment process shut down, and you can carry on and hopefully make the gains back.
So going forward, would you expect, I mean, have you been seeing consistent returns over the last 2 years? And do we expect those to carry on over the next 3 to 5 years? Are the trends that we're observing right now likely to carry on and favor FX alpha, obviously?
So I think the environment is actually beginning to improve. So the last few years has been a bit more challenging for FX. There has been the ability to generate alpha, but it's been probably a more volatile, lower information ratio return source. But the divergence of monetary policy should be a key driver to help generate alpha in FX going forwards. Also, something I mentioned in a presentation this morning, this movement in correlation of FX with general risk assets is very encouraging. That's a sign that FX should be going to more trading back on the fundamentals rather than trading on a purely risk-on, risk-off basis. So I think the outlook is more encouraging going forward than it has been over really since the post-financial crisis period.
Right. Is that the same for you, Jonathan?
I would basically agree with that. I think the investment signals that many people use have not worked well in the recent period. And I can see an environment where fundamentals are coming back, where you're going to see a bit more volatility and with more divergence of interest rate expectations. I think the sorts of approaches that are commonly used to manage active FX exposures will start to be more effective.
So should people now, I mean, for companies to be able to generate more alpha, obviously that requires investment. Do you think right now is a good time to be investing a little more into developing new systems to better cope with the current trends and coming trends in the future?
Well, I would hope that most asset managers already have systems in place to manage their FX appropriately. So, but it might mean, your question might be taking in the sense of more resources to actually do the analysis and work out what sort of exposure do I want to have, more systems perhaps in getting better estimates of the correlations between FX and different asset classes.
Also work out innovative ways in which we could, approach the subject matter.
So again, you're not talking about the execution, you're talking about the analysis.
The analysis, yes.
Well, I mean, I absolutely agree with that, yes. I mean, I think this is a great way of giving breadth to the number of investment decisions you can make and therefore improving your long-term returns.
Do we see a lot of innovation happening within the industry?
I think we're constantly trying to work out what's going on, what the drivers are, what are the best ways to make alpha. I think it's an ongoing quest.
It's definitely an ongoing one. Yoav, you obviously have a bit of a systematic and discretionary sort of approach to FX. How much do you actually invest in sort of further developing and tweaking those parameters? And what, for a company like yourself, what would you think are the main factors driving FX alpha over the next, or would be driving FX alpha over the next few years?
R&D was about 6 years. And since then, it's been a refinement process, an ongoing refinement process of both the concept as well as optimization of the trading of this concept. In other words, experience counts. It's one thing to know the concept, and it's another thing, very different thing, to optimize the trading results once an opportunity presents itself. The last few months were quiet. There were the so-called false breakouts. But the last 4 weeks or so, I got like 4 major breakouts. So certainly volatility picks up, and I hope that we have seen the bottom.
Yeah. Are we seeing more flows going into emerging markets as opposed to just the G10 currencies so far? Do we think there's more potential looking at EM stuff as opposed to G10?
I think we'll see flows coming out of EM actually and going back into the dollar. I think people went in when they lost confidence in the dollar, and I think the dollar's on the way back now. So I think the investment reallocations will be the other way.
James?
I agree with Jonathan.
Right. So EM, in a sense, basically, there's more potential, I suppose, with maybe China coming up. There's Russia. We don't know. Would those not represent sufficient opportunities in the market to generate more alpha?
Well, look, I mean, we would always regard it as a two-way thing. We can make money if we sell the renminbi and it depreciates, or we can make money if we buy the renminbi and it appreciates. What we need is an investment view. We need to have a strong enough signal, and then we need to be right in the way we use that signal. So at the moment, actually, if you look at the dollar exchange rates of a lot of EM currencies, they look sort of in the middle of the range, neither particularly expensive nor particularly cheap. If you look at the EM currencies that make up a typical bond index, I would say, if anything, they still seem to be expensive. And therefore, it's certainly not the right time to be going long these currencies. You might be able to make some money going short, but then you've got the problem that you're often experiencing negative carry if you do that.
Right. Gordon?
I think the inclusion of EM, so whether you want to invest in the ability to go long short, is very important in any currency portfolio. So historically, a number of investors have stuck either to G10 or EM. I think that line has really blurred over the last 15 years. That rather than having this sort of complete distinction and a cut-off at, let's say, the New Zealand dollar, and then you're moving into emerging market territory. So there has been some degree of economic convergence. There is still significant differentiation. But if we look at the volatilities of these currencies, if we look at their behaviors in relative to risk, we've certainly seen convergence. So I think adding breadth to any currency portfolio by trading both the G10 and EM together is an important step for any investor.
Very much so. Right, we're almost at the end of this. Any questions from the audience, please?
Hello, my name's Angus Campbell. I'm from FX Pro. I have a quick question for Gordon. Does BlackRock have specific alpha FX funds, pure FX funds, that are obviously trying to generate alpha?
We do, yes. So we have FX alpha as a source in multi-asset portfolios, and we do have standalone FX funds.
Okay, sorry. So my second question would be, you touched on, obviously there's a lot of technical fundamental analysis that goes into their strategies, back testing. You also touched on there being some forward testing. I was wondering if you maybe explain a little bit about that sort of forward testing.
That's to try and think about, for example, if we had a fundamental signal based on economic growth, let's say, what regime do we think that works in? So that's trying to anticipate if we think the Fed is going to begin normalizing policy and we may have higher volatility going forward, will our growth signal still work in that environment? I will say that's much, much harder than the backtesting. Backtesting is all easy. You can fit and basically make any P&L stream go up in a straight line. But to try and have a sort of more forward-looking aspect to the markets is increasingly important in understanding which of the sort of strategies will work for us.
So they're based more on fundamental forward testing, not technical.
Yeah.
Okay. Thank you very much.
Saeed Amin from the Talesians. I've just got a question. Where do you think trading FX volatility comes into play as a source of alpha, or do you see it more as a way of hedging your risk?
Jonathan?
I think you can trade that. You need to have an investment view, you need to have your investment signals, and you need to get it right. So clearly you might have a model that says, I think volatility is too low, I think volatility is going to rise. And there could be something generating that signal, and then you can certainly trade that. You can go long options, or you can perhaps put on a derivatives trade to take advantage of that. I think it's very common to, if you look at the sources of alpha, to identify how much alpha is coming from volatility. So we tend not to trade volatility directly, but when we've done analysis on our past returns, we find there's a slight positive exposure to volatility. In other words, that our FX strategy tends to do better when volatility is picking up. So it's something that comes out of that indirectly. We do look at volatility, but we don't feel that's the main area of expertise. It's not like we're trading a lot of option strategies.
But as a rule of thumb, increased volatility should present more and more opportunities by all trading styles.
I mean, on that point, is it just that if you've got more movement, if you get it right, you're going to make more money?
True.
Because the alternative approach might be, say, if you think we're going to stay in a low volatility environment, you could simply increase the size of your positions. And again, if you get it right, with a larger position, you'll make as much money. Or is it something about the volatility environment that changes has a broader implications that what's happening in FX, which means that investment signals, or the ones that are commonly used by FX managers, are more successful?
Well, to get it right is the name of the game. But generally speaking, if the market doesn't move, then opportunities are not there. I mean, the market is stagnant. Once the market moves, there are more opportunities. The big question is to know when it's false, when it's not.
But Jonathan, you're doing medium-term trades mainly, aren't you? So you're not really looking as a short-term player.
I just look at the signals that I think work best. And I have more confidence in signals whose payoffs tend to be uncertain, in that you don't really know whether it's going to be happening next week, or you might have to wait 6 months, or you might have to wait 18 months. And in that sense, they're more medium-term strategies. It's not a deliberate decision to avoid short-term strategies, because actually the ideal thing will be to generate a bit of alpha every single day.
Oh, ideally, yeah. Just out of interest, though, when some years ago everyone obviously was talking the euro down, everyone said it was overvalued. Now, at that time, were your fundamental signals saying to you, I should be selling the euro, and did you sell them? Because a key element in this, when you're looking at managing FX, is, of course, is where are your stop levels? How long can you hold on to that position? Some people simply can't hold on for too long. If you're a big fund, or you're looking at, you can maybe carry it for a while on conviction. How do you deal with that?
I think your euro example, you're probably referring to when it got to about 150. And that was just after the ECB had raised rates, and then they had to reverse it.
No, I'm not referring to that one actually. Because that's when that was intervention by all the. Oh God, that goes a few years back actually. Trichet and Bernanke.
Okay, but your general question is, how do you cope with stops? And I think it partly depends on the outcome desired by the client. So some clients might say, I have a specific drawdown limit, in which case you will have to start decreasing risk after a certain stage. But For most of our portfolios, what we try and do is to manage the amount of risk that we're taking in line with the degree of investment opportunity, so that we're never hopefully going to be in a position where we are forced to close down positions if we think the investment signals are still positive for those positions. That's a situation we want to avoid.
It's actually a very good point. How important do you think having proper systems to manage the exposure or the risks work together with successfully generating alpha?
I think it's extremely important. It's two sides of the same coin. So if you have an investment signal, how large should your trade be based on that signal? And the only way to work that out is part of the process is to have a good risk system.
Excellent. Well, thank you very much, gentlemen. Thank you.
Gentlemen.